Something broke in Shanghai. Not metaphorically, not as a figure of speech borrowed from the casual vocabulary of financial commentary. Something in the actual, physical, institutional architecture of the global silver market cracked open. And the people running the exchange, the people whose entire professional mandate is to prevent exactly this kind of rupture, were forced to pull the emergency brake. That is where we begin. Not with a prediction, not with a chart pattern, with a fact. The Shanghai Futures Exchange, the SHFE, one of the most powerful commodity trading venues on Earth, halted trading in silver. And silver, let us be clear about this, is not some obscure derivative instrument or a thinly traded microcap speculation. Silver is the metal that runs the solar panels powering the modern world, the metal woven into every smartphone, every electric vehicle, every data center humming with artificial intelligence. When the exchange that trades it cannot function normally, the question that demands an answer is not merely what happened, the question is what it means. Here is what happened. The Shanghai Gold Exchange, the SGE, which handles physical silver delivery, and the Shanghai Futures Exchange, which handles the paper futures contracts, began experiencing something that veteran traders described with a word they rarely use: unprecedented. Silver premiums in Shanghai, the markup that Chinese buyers routinely pay over the international spot price, erupted. Under normal conditions, that premium runs somewhere between 2 and 5%. There are structural reasons for it: import duties, value-added tax, the logistics of moving metal across borders and through a tightly controlled import quota system managed by a handful of licensed Chinese banks. That premium is baked into the market. It is expected. It is background noise. What happened recently was not background noise. It was a detonation. The SGE silver price surged above $82 per ounce at its peak, at a time when the international spot price in New York and London was trading in the low to mid-70s. To put that in the plainest terms possible, silver in Shanghai was commanding a premium of somewhere between 10 and 15% above what the rest of the world was paying. Not 2%, not 5, 10 to 15. And when the futures side of the market on the SHFE began reflecting that same explosive pressure, hitting daily limit moves, meaning prices rose the maximum amount the exchange permits in a single session on consecutive trading days, the exchange did not wait. It raised margin requirements dramatically, widened its daily price limit bands, imposed position restrictions on specific contract months, and in the most direct sense of the phrase, shut the door on normal trading. A full-day suspension protocol was activated. China's only public silver futures investment fund was halted for the second time in a matter of days, after trading at a staggering 36% premium over SHFE contracts. 36%. In a market where 2% is considered elevated. Now, the mechanics of how an exchange halt actually works are worth understanding carefully, because this is not like what you picture when you hear the phrase circuit breaker on the New York Stock Exchange. That 15-minute pause when a stock freezes and then resumes. The SHFE uses a layered escalation system. When silver futures hit the daily limit ceiling, what traders call limit up, buying orders above that ceiling simply cannot execute. The market freezes at the top. If it hits limit up on consecutive sessions, the exchange escalates. It widens the bands, giving the market more room to find equilibrium. But simultaneously, it raises margin requirements. Where traders might ordinarily post 8% of a contract's value as collateral, they suddenly find themselves required to post 12 or 15%. That is a deliberate squeeze on leveraged speculators. If you are writing a long silver position on thin margin and the exchange suddenly demands 40 to 80% more cash immediately, you either wire the money or your position gets liquidated. The exchange is forcing the weakest hands out, deliberately reducing the speculative pressure. And if prices continue pushing against the new, wider limits even after those measures, the exchange can restrict the opening of new positions entirely, or suspend trading in specific contract months outright. That is precisely what unfolded. Not in one dramatic bell-ringing moment, but in a cascade of interventions, each one more aggressive than the last, each one telling the market the same thing in progressively louder terms. This has gone too far, too fast, and the infrastructure cannot safely contain it. The important question, the one that should arrest your attention, is not whether the exchange was right or wrong to intervene. Reasonable people can debate the merits of administrative price controls in a commodity market. The important question is why the intervention was necessary at all. Exchanges do not halt trading because the price moved. They halt trading because the price moved in a way that threatened to cascade into margin defaults, broker insolvencies, and clearinghouse exposure. That is a different category of event entirely. It means the pressure underneath the silver market had reached a level that genuinely alarmed the people whose entire professional purpose is to manage that kind of pressure. And that, more than any price chart, more than any analyst's forecast, is the signal worth understanding. If you have watched this channel for any length of time, you already understand that the silver market is not a collection of isolated regional pools. It is a single, interconnected, globally arbitraged system where a premium explosion in Shanghai does not stay in Shanghai. It travels. It pulls. It restructures the flow of physical metal around the entire planet with the quiet, irresistible force of basic economics. And right now, that force is pointed in one direction, east, with a conviction and a magnitude that has not been seen in living memory of this market. Consider the logic from the perspective of a silver refiner in Switzerland, or a mining operation in Mexico, or a bullion bank in London. If Shanghai is offering $82 per ounce for physical silver, while the international spot price sits near 73, which is approximately where silver traded in late April and early May of 2026, where does the metal go? The answer is not complicated. It goes to Shanghai. Every rational actor in the supply chain redirects toward the highest-paying buyer. That redirection does not happen instantaneously. Silver must be refined to the correct specifications. It must be shipped. It must clear Chinese customs through a bottleneck controlled by licensed import banks. The physical pipeline responds slowly to price signals, which is precisely what allowed the Shanghai premium to keep expanding, the gap between what the price was screaming and what the supply chain could actually deliver. But the intention shifts immediately. The moment the premium spikes, the gravitational reorientation of global silver flows begins, and the consequences for Western markets are already measurable. COMEX registered silver inventories, the metal actually available for delivery against futures contracts, have declined by roughly one-third since their peak in September 2025. One-third, in less than a year. The LBMA vault system in London, which serves as the primary settlement hub for the international spot market, has been experiencing similar directional pressure, with silver flowing out rather than accumulating. These are not alarming numbers in isolation. The COMEX has always operated with what analysts politely describe as a leverage ratio, far more paper ounces traded than physical ounces sitting in the vault. That is how futures markets function. They are price discovery and hedging mechanisms, not primarily physical warehouses. But the leverage ratio only works under one critical assumption: that enough physical silver will be available to satisfy any delivery demands that materialize. When that assumption is being stress-tested by sustained eastward flows of physical metal, the math begins to produce uncomfortable outputs. If this is the first time you are encountering these ideas and you want to go deeper, if you want to understand the full architecture of how the global silver market actually functions, how the COMEX relates to the LBMA, how Chinese import quotas shape global supply flows, hit that subscribe button right now, because this is exactly the kind of analysis we build here, methodically and without the noise. The people who stay informed are the people who see these dynamics before they become headlines. Now, the supply story has a structural dimension that predates the Shanghai eruption and gives it its real gravity. The Silver Institute, the industry's primary data organization, has documented consecutive years of global silver supply deficits, not a one-year anomaly, a sustained, multi-year structural condition in which total demand from industrial consumption, investment, jewelry, and electronics has exceeded total production from mines and recycling. The 2026 shortfall is estimated at 46.3 million ounces, according to current Silver Institute projections, the sixth consecutive annual deficit. That gap has been filled by drawing down above-ground inventories, ETF holdings, vault reserves, exchange stockpiles. That process can continue for years. There is a substantial quantity of accumulated above-ground silver in the world, but it cannot continue indefinitely. At some point, the remaining inventory concentrates in hands that have no intention of selling, or in forms that cannot be quickly mobilized. And the Shanghai premium spike is one of the clearest real-time indicators that we may be approaching that threshold faster than most analysts anticipated. The demand side of this equation does not offer the comfort of ambiguity. China is the world's largest consumer of industrial silver, and its consumption trajectory is not merely rising, it is accelerating. China's solar manufacturing sector alone consumes hundreds of millions of ounces annually, and government installation targets for photovoltaic capacity have been consistently exceeding projections. The solar panel industry, which barely registered as a silver demand category 15 years ago, now represents one of the largest and fastest growing single sources of silver consumption on Earth. Layer on top of that the electric vehicle sector, 5G infrastructure build-out, data center expansion driven by artificial intelligence investment, and the full range of electronics manufacturing in which China is the dominant global player, and what you have is a demand profile that is structural, durable, and growing faster than the supply chain was designed to accommodate. Mining supply has offered no relief. Global silver mine production has been essentially flat for several years. The geological reality is that many of the world's major silver deposits are mature. New discoveries of significant scale have been rare. New mines require a decade or more of permitting and development even when economics justify the capital expenditure, and approximately 70% of silver production comes as a byproduct of mining copper, zinc, lead, and gold, which means silver supply is partially hostage to investment decisions made in completely different commodity markets. When copper producers invest in new capacity, more silver arrives. When they do not, silver supply stagnates regardless of what silver's own price is signaling. The Shanghai premium is the market's way of screaming into a supply chain that cannot immediately respond, and watching the scream get louder with each passing session until the exchange itself was forced to intervene. There is a dimension to the Shanghai silver story that resists the comfortable vocabulary of ordinary market analysis. It requires us to think not merely about supply and demand curves, not merely about futures positioning and margin mechanics, but about the strategic intentions of a nation that controls approximately 2/3 of the world's silver refining capacity and has demonstrated, repeatedly and without apology, a willingness to use commodity access as an instrument of geopolitical power. China is not simply a large silver consumer. China is the dominant processor of the world's freshly mined silver. Estimates from multiple commodity analysts suggest that Chinese refiners handle the majority of global silver bar production, meaning that much of the silver extracted from mines in Mexico, Peru, Australia, and elsewhere passes through Chinese industrial infrastructure before it reaches final users anywhere on the planet. That is not a minor footnote. That is a structural choke point of extraordinary significance at a moment when geopolitical tensions between China and the Western world are elevated, and the appetite for economic weaponization of commodity flows has been demonstrated across multiple sectors: rare earths, semiconductors, critical minerals. The concern now crystallizing in market conversations is whether China might impose export restrictions on silver, retaining its refined output for domestic industrial use, and allowing Western markets to scramble for what remains. That scenario, if it materialized, would transform the current supply tightness from a manageable deficit into something considerably more acute. China's government has articulated a strategic doctrine it calls dual circulation, the ambition that the Chinese economy should be capable of robust self-sufficiency, even if external trade relationships are disrupted. In a world where the energy transition depends on silver, where solar manufacturing is China's chosen instrument of global industrial dominance, and where the electric vehicle sector represents Beijing's vision of 21st century economic leadership, securing physical silver access is not merely a commercial decision. It is a matter of national strategy. And when you observe Chinese silver imports running at elevated volumes, in some recent periods approaching record levels, while domestic premiums simultaneously signal that demand is outstripping even those elevated imports, the question that emerges is whether some portion of that metal is being set aside, whether China is building a strategic buffer, an insurance policy denominated in silver ingots rather than treasury bonds, against a future in which access to this metal becomes contested. That question cannot be answered with certainty from outside Chinese strategic planning circles. But the circumstantial evidence, the import volumes, the premium levels, the trading halts, the dominance of refining capacity, assembles into a picture that serious analysts find difficult to dismiss. The paper market dimension of this story carries its own weight. In 2020, J.P. Morgan Chase paid a $920 million settlement to the Department of Justice over spoofing charges in precious metals futures markets. Traders at the bank were convicted of placing orders they had no intention of filling, fake orders designed to manipulate price over years. That is not a conspiracy theory. That is a federal enforcement action. It is in the public record. It is cited here not to suggest that manipulation explains everything happening in silver markets today, but to establish that the gap between the paper price of silver and the physical reality of silver supply has, at various points in recent history, been artificially maintained by conduct that the law defines as criminal. The Shanghai premium is one of the most direct and measurable expressions of that gap. When physical silver in China trades at 10 to 15% above the internationally quoted spot price, the price set primarily through COMEX futures, it is the market's most honest mechanism announcing that the paper price and the physical reality have diverged. Every ounce of physical silver flowing east, every declining inventory reading at the COMEX, every elevated London lease rate, every retail dealer premium that refuses to compress back to historical norms, these are the accumulating data points of a market in which the paper architecture is being tested against physical reality. What does this mean if you are watching from the United States, checking the spot price, tracking the COMEX, monitoring dealer premiums on silver eagles and bars? It means you are watching a globally connected system experiencing stress at one of its most critical nodes, and that stress is propagating outward through every linked market. Silver spot prices have already reflected part of the adjustment, trading in the $72 to $78 range in late April and early May of 2026, up more than 118% over the prior 12 months. But the premium structure in Shanghai suggests the physical market believes the price discovery process in the West has not yet fully absorbed what the East is experiencing. The sixth consecutive annual supply deficit, the declining COMEX registered inventory, the eastward gravitational pull on global supply flows. These are the components of a system whose equilibrium is being renegotiated in real time, and Shanghai is where the renegotiation is most visibly underway. The lesson of the SHFE trading halt is not that silver is going to a specific price by a specific date. Anyone who offers you that kind of precision is selling something other than analysis. The lesson is that the infrastructure of the global silver market was stressed to the point of institutional intervention by forces that are structural, durable, and accelerating. Industrial demand is not a trend that reverses when speculators take profits. Chinese strategic positioning does not unwind because an exchange raised margin requirements. Global supply deficits do not correct themselves in a quarter or even a year when mine development timelines are measured in decades. The pressures that caused the Shanghai trading halt will not be dissolved by the halt itself. They will rebuild. And when they do, when the speculative froth has been rinsed out by the intervention, and the fundamental buyers return to a market that is temporarily corrected, the second wave of that signal will carry the full authority of the first wave's confirmation. Now I want to hear from you, and I mean that genuinely. Drop your perspective in the comments below. Are you watching the COMEX inventory numbers? Are you tracking Shanghai premiums? Do you think the physical market is telling us something the paper price has not yet acknowledged, or do you think this is a regional story that will resolve itself quietly? The best analysis in precious metals has always come from people paying close attention, and this community has some of the sharpest eyes I have encountered anywhere. Tell me what you are seeing. And remember, this is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.